What type of mortgage should I get? What are the types of mortgages? There's four, really. There's actually several, but the four most common ones that you're going to be in almost every scenario is conventional, FHA, VA, so veterans, military, and then USDA. So we'll cover USDA first. USDA, we don't do a lot of, I'll be honest with you. USDA, the big benefit of USDA is 0% down, but their debt to income calculations are more strict. The property has to be in a specific area, and it can't have a lot of luxury, which like a luxury would be a swimming pool. Like it's probably going to get denied for having a swimming pool or something they deem as a luxury. And the biggest one is their underwriting times are typically 45 days. So the USDA has to underwrite it, and when they underwrite it, they don't really care about customer service that much. So we kind of get it back when we get it back. Because of that, you don't see a lot of USDA at all. And there's income restrictions and some things. So VA is great if you're a veteran. If you are a veteran, take full advantage of the 0% down VA. Rates are typically really good. It's 0% down, and their debt to income ratio is probably one of the most flexible. VA is great. If you have questions about VA, let me know. There's a VA, if you're 100% disabled veteran, it's even better for you. There's a VA funding fee that you pay if you are not 100% disabled, but if you're 100% disabled, you don't pay it. So that is the con. With a lot of things VA, you want to be 100% disabled to get the full benefit of what they offer. Conventional and FHA, these are the two biggest competitors, because for the person that's not military, you're probably looking at conventional or FHA. In this market right now, FHA's rates are a lot better. FHA, the negative of FHA, there's two. It's all around mortgage insurance. There's mortgage insurance that on FHA loan it's called mortgage insurance. On a conventional loan it's called personal mortgage insurance. It's both mortgage insurance. So it's just they call them both two different things. FHA, you're going to have mortgage insurance on it unless you put 10% down for the whole loan. If you put more than 10% down, it's for the first 10 years, but you're probably going to refinance before that. So don't even get caught up on that. But FHA, if you do the standard 3.5% down payment, which is the least you can put down, you have mortgage insurance for the life of the loan. There's also a mortgage insurance premium that is rolled in. This premium can be $3,500 to $5,500 depending on the size of the property you're buying. You don't pay for it yourself immediately, but it's rolled into the loan, which is your equity at the end of the day. So I always like making sure people know about that. And then 3.5% down, FHA, the debt to income ratio is typically around 55% or less, so more flexible on income. All around a great product though. I do a ton of FHA deals. From the typical deal that I do, I would say I'm about 50-50 FHA or conventional when people are deciding between the two. VA is a whole other thing, but between those two, I do them again about 50. So that's FHA. The interest rates right now are really good on them, and the reason that the interest rates are so good is because that mortgage premium that's rolled in to your loan kind of backs the investor in case you don't make your payments and you get foreclosed on. That's FHA. Conventional and FHA, think Govy, so it's a government loan. Conventional is not a government loan. It's regulated by Fannie and Freddie Mac, who they're kind of the government, but they don't want to be called the government. They are really good. If you put 20% down or any time during your mortgage process or your home process, you have 20% equity in the home, that mortgage insurance, you don't pay it anymore. So some people will put 20% down to begin with. They will just never have mortgage insurance. There's no mortgage insurance ever rolled in to conventional, but because of that, their rates are a good bit higher right now. They minimum amount down. Here's the hard part with conventional, and I'll touch on this in another down payment video. You can put 3% down on a conventional mortgage. There's qualification around it though. So usually your debt to income ratio has to be under 45%. Sometimes there's an income limit. There's some specific things as far as that goes, but you can go down to 3%. Their standard's 5% though. So 5% or more is where conventional usually lives. So FHA and conventional, those are your two main ones. If you first-time homebuyers, a lot of the time love FHA. Conventional, first-time homebuyers like conventional too sometimes. When the rates are more aligned, they're way more competitive on which one do I go with. But right now, most people who are not putting a big down payment down are going FHA, and then people who are putting down 20% or more go conventional, just because not having that PMI. Anyways, any questions at all ever about loan products, let me know. There's a whole other side of this, which is non-QM, which is bank statement loans and things like that, which if you think you want to look into that, let me know. But I'll probably recommend it to you too after I look at your finances, if that makes more sense. Have a blessed day. If you have any questions for me ever, let me know. Bye.